SoundHound just reported Q3 earnings yesterday. $42 million in revenue, up 68% year over year, beat analyst estimates and raised full-year guidance to $165 to $180 million. The growth is real, but the profitability question is what everyone's really focused on now. This isn't financial advice, just my breakdown of what came out yesterday. Do your own research before making any investment decisions. So let's start with what actually happened in Q3 because the revenue growth is real. They did $42 million, up from $25.1 million in quarter three last year, which beat the consensus estimate of $40.93 million. For the first 9 months of 2025, they're at $114 million in revenue, up 127% year over year. The guidance raised to $165 to $180 million for the full year implies Q4 is going to be strong, probably in the $51 to $66 million range, depending on where in that guidance range they land. The gross margin is 59.3% on a non-GAAP basis, which is solid for a SaaS/AI software business. What's more interesting is the profitability trajectory. They're still losing money. Non-GAAP net lost was $13 million this quarter, but that's actually an improvement from the $15 million loss in Q3 last year. Adjusted EBITDA loss was $14.5 million, improved from $15.9 million. So they're growing revenue 68% while reducing losses, which is the right direction, but not fast enough for where the stock's trading. Operating cash flow for the 9 months is negative $76.3 million, which means they're burning about $25 million a quarter on average. They've got $269 million in cash with zero debt. So the runway's fine for now, but at this burn rate, they've got maybe 10 to 11 quarters before they need to either get to cash flow positive or raise more capital. The market's clearly pricing in profitability concerns despite the growth story. The customer wins they announced yesterday are actually pretty impressive. When you look at the breadth, they're landing deals across automotive, financial services, healthcare, insurance, restaurants, retail, energy, telecom. It's genuinely diversified, which matters because it de-risks the business model. On the automotive side, they signed a major globally renowned sports car brand. They didn't name it, but speculation is it's someone in the Ferrari/Porsche/Lamborghini tier, expanded Jeep's Chat AI across Europe, expanded TOG throughout Germany, and signed 2 prominent two-wheeler brands in India. The automotive play is interesting because it's not just about voice assistance for navigation. They're positioning for voice commerce where you can book restaurant reservations, pay for parking, or order food directly from your car. That's a revenue share model where SoundHound gets a cut of transactions, which is way more valuable than one-time software licensing. 3 of the top 10 global financial services institutions bought additional services, which suggests existing customers are expanding usage. 2 renewed contracts. New enterprise deal with a U.S. credit union organization. Financial services is a high-value vertical because contact center automation has massive ROI. If you can deflect even 20 to 30% of calls to AI, the cost savings are substantial. In healthcare, they signed a large precision medicine provider for an agentic AI solution, a U.S.-based regional hospital system for the Amelia platform, and renewed with a leading healthcare company. Healthcare is notoriously hard to penetrate because of HIPAA compliance and risk aversion, so wins there signal their technology meets enterprise-grade security and regulatory requirements. In restaurants, they added Firehouse Subs, Five Guys, McAllister's Deli, and fully deployed at MOD Pizza, Habit Burger, Red Lobster, Torchy's Tacos. They already had Chipotle and Casey's, so the restaurant portfolio is becoming pretty significant. The restaurant use case is drive-through automation and phone ordering, and the ROI is clear. Labor costs are high, turnover is high, and AI can take orders 24/7 without mistakes. The CEO mentioned that tech platform giants are poised to deploy voice ordering to millions of users in 2026, and global OEMs are engaged to launch voice commerce in vehicles. Those are the kinds of partnerships that could scale revenue dramatically if if they execute. But 2026 is still a ways out, and there's execution risk. The IoT deal with a large China-based company for double-digit millions of AI-enabled smart devices is interesting because it shows they're not just doing voice assistants. They're getting embedded into consumer devices at scale. That could be anything from smart speakers to home appliances to wearables. What they're trying to position is this Agentic Plus framework, which combines generative AI, multi-agent autonomous orchestration, and deterministic models. The pitch is that pure LLM-based approaches from OpenAI or Anthropic aren't reliable enough for enterprise use cases where you need deterministic outcomes, like processing a drive-through order or handling a customer service call. You can't have the AI hallucinating or giving wrong information. So SoundHound's approach layers in deterministic logic on top of the generative AI. The Amelia 7.3 update incorporates their speech-to-meaning technology, which apparently delivers industry-leading latency, meaning faster response times than competitors. Latency matters a lot in conversational AI because if there's even a half-second delay, it feels unnatural and users get frustrated. Their speech-to-meaning tech processes intent in real time without waiting for the full sentence to finish, which is supposedly faster than traditional speech-to-text-to-intent pipelines. Whether that's actually a defensible moat or whether the big tech companies can just copy it is the billion-dollar question. Google has Voice AI built into Android and Google Assistant. Amazon has Alexa. Apple has Siri. All of them have way more resources and distribution than SoundHound. The counter-argument is that enterprises don't want to depend on hyperscalers for critical voice AI infrastructure, so there's a market for independent specialists. If you're a bank or a healthcare provider, do you want your customer service AI running on Google's infrastructure where they potentially have access to your data? Maybe not, and SoundHound's been doing this for years. They've got domain expertise and customer relationships that aren't easy to replicate. They understand the specific requirements for drive-through automation versus contact center automation versus in-car voice interfaces. But it's naive to think they're not competing against massive companies with infinite resources. Google just launched Gemini Live, which is extremely capable. OpenAI has advanced voice mode in ChatGPT, and both are getting better fast. The question is whether SoundHound's enterprise focus and domain expertise create enough differentiation to sustain premium pricing and keep big tech from eating their lunch. The profitability timeline is what matters most at this stage. The company's been growing top line aggressively, but burning cash to do it, and at some point that needs to inflect. They're improving margins and reducing losses, but not at a pace that changes the fundamental equation yet. The guidance raise is a positive signal. Management clearly has visibility into Q4 and feels confident they'll deliver at least $165 million for the year. But that Q4 revenue implies somewhere around $51 to $66 million, and the wide range suggests there's uncertainty. The voice commerce opportunities with OEMs and tech giants launching in 2026 are exciting, but that's future revenue that hasn't materialized yet. Right now, they're growing fast and hoping they can get to profitability before the cash runs out or before they need to raise more capital at potentially dilutive terms. The $269 million cash balance gives them runway, but the negative operating cash flow means that runway has a timer on it. The bull case is straightforward. Enterprise AI adoption is accelerating. Voice AI is underpenetrated across industries. SoundHound has a unique technology stack with the Agentic Plus framework. They're winning major customers across diverse verticals. And the 2026 OEM tech giant partnerships could be massive revenue accelerators. If voice commerce in vehicles becomes a real thing and SoundHound powers it for major automakers, that's a huge TAM. If the IoT device partnerships scale, that's another massive TAM. The restaurant business is already showing traction with real deployments at major chains. The bear case is equally straightforward. They're burning $25 million a quarter with no clear timeline to profitability. Competition from big tech is intense, and the 2026 partnerships are speculative until they actually launch and generate revenue. These earnings didn't change the fundamental thesis. They're still a high-growth, cash-burning AI company with promising technology and customer wins, but no profitability yet. Whether that's compelling depends on your conviction in the voice AI market and their ability to capture it while managing burn rate. Drop a comment and let me know what stock you want analyzed next.